Okay, hello everyone. Thanks for joining us today. Today's topic of conversation, how to purchase an multi-unit housing with a loan to value max of 95%. I'm Jason Walker, and I've been selling real estate since 2010. And I don't know that I've ever sold a duplex or fourplex or any sort of plex with a loan to value of 95%. So this will be something new for even me to learn today. Today as a guest speaker, we have Stefanie Gilbert. You want to tell us a little bit about yourself, Steph?
Yeah, I own Altitude Home Mortgage. I'm over in Sheridan, Wyoming. I've been in the mortgage industry about 15, going on 15 years. So I tried to leave once or twice and sucked me back in. So, but yeah, I've been working with Jason since I started in the industry.
Yeah, we've both been kind of selling alongside each other for all of our career for the most part. So that's been super helpful because Stephanie's always got lots of wisdom to share along and vice versa. So I've always appreciated that relationship with her. Before we get started, be sure if you're watching this video or watching this recording now or later or whatever, be sure to subscribe and get the notifications off the appropriate channels that you're watching this on, because there will be additional videos and educational opportunities coming down in the future. So with that said, Stefanie, I'll let you take the floor and dive right into this loan type coming.
All right. Well, I'll keep it short and sweet as far as what's changed, because it's a huge change. But so effective 10 days ago, so November 18th of 23, Fannie Mae increased the loan to value, decreased the down payment requirements for a multifamily primary residence. So prior to November 18th, if you wanted to purchase a duplex or a fourplex or threeplex, I guess for that matter, and you were going to live in one unit, your minimum down payment requirement was 15%. Now it's 5% down payment, which is huge. I think what it does is it opens the doors for more first-time home buyers to purchase and get into investment properties. And so just really, I mean, it's a huge change. So I think specifically even in Gillette, because you guys have quite a few fourplexes over there, quite a few multi-unit properties. We don't necessarily in Sheridan, but definitely different areas for sure do. So that's kind of the big portion of it. Basically, if you've ever heard of the term house hacking, it's probably one of the best ways or easiest ways to be able to build a real estate portfolio. And so basically what house hacking is you purchase a property, live in it for a period of time, typically about 12 months, and then you move out, rent it, upgrade, and continue to do the same thing, because your interest rate and your terms for a mortgage are always better on a primary residence. So as long as you do a conventional loan or an FHA loan, you can then, kind of a VA loan, but you can then convert that to a rental property as you move out after 12 months.
Well, I agree with that. One thing that I've done throughout my career is, we get young people in, especially, and they want to learn how to build equity through real estate or start their real estate portfolio. And there's really a lot of roadblocks that I feel like in the lending industry to get into income producing properties. This is one of those opportunities where there isn't any roadblocks, other than you got to commit yourself to living on site or in the property for, like you said, 12 months or, whatever the rules are within that particular mortgage. And so it's kind of a light way to get our young people into housing quickly, housing and an income producing property. The same I find with elderly. They're on a fixed income, and they don't want to go to assisted living or some other type of living arrangements past a house, but yet they want to kind of be on their own still. This provides them even an opportunity to be still keep their fixed income and be able to afford a house, whereas maybe they wouldn't be elsewise.
Yeah, absolutely. Well, and I think because the idea of even first-time home buyers purchasing a property is scary or can be scary in general. And then it definitely is overwhelming and scary for most trying to purchase a property that can also be an income producing property. But I think when you sit down and look at the numbers, oftentimes, depending on, the market rent, I mean, I've seen people be, even before this, but be able to purchase a fourplex and live in a unit and not, I mean, have their house payment paid for. So that's a quick way to be able to build equity, as well as, I mean, if you don't have a house payment, you can start sticking that money away or paying down principal so that you can turn around and, buy another property and be able to then rent out that fourth unit or additional unit later on too.
One of the good things that comes along with living in the unit and being forced into that is you get to learn how to be a landlord, and you get to learn how to manage people and your property at the same time. Whereas if you just jumped into it and didn't have that experience, boy, there's some real loopholes that you can find yourself trapped in, or traps basically that you find yourself in, and without the appropriate experience, you don't know how to navigate those waters if you end up in them. So I think that's a good thing. Good, and there's good and bad that you're going to experience, but it does force you into the learning curve of being a property manager. And then eventually, you get to a point where it's just passive income. So you move from, hey, I'm going to own this property and I'm going to let my tenants pay for the mortgage, hopefully. And then I'm going to move out and turn it into completely passive income property and move on to the next stepping stone and the next stepping stone. And so, yeah, just super good opportunities there. And like you said, the kind of the terminology out there in the social world is house hacking. But with interest rates going up on mortgages and people being on fixed incomes, whether they fixed income with their employer or, like I alluded to, with the elderly, all of a sudden this is a bigger topic of conversation than we've probably seen in our careers of being in real estate, I feel like.
Mm-hmm. Yeah, it's a big change. And, over the last several years, we've definitely seen lots of changes that haven't always been great for home buyers, but this is definitely a huge win, and opening up more opportunities for people.
So I pulled up a property that's currently for sale. Would we have a chance to just run through a live scenario on how that would unfold?
Mm-hmm.
Okay, I'm going to share my screen here. Okay, so here we got, before I jump into this, I'm going to lay the disclaimer that even though Steph and I talk about Sheridan a lot, it's only because we live and work in those communities, but we are licensed Wyoming agents. She's licensed as a mortgage lender. I'm licensed as a realtor. Doesn't mean we're just secluded to those areas. So keep that in mind that, our licenses do say Wyoming. So if you do got questions about your particular area, you should still contact us, and we'll start moving through the motions with you. But anyway, this is a property that's currently for sale in Gillette, Wyoming. I just randomly picked it out of the multiple listings today. It's a duplex, and we see, hopefully everybody can see my mouse moving, but we see that it's a 2-unit building. They're both 2-bed, 1-bath. And currently both units are being rented out as a full income producing property at $900 a month. There is one garage for each unit, and they are on 6-month leases. So Steph, if I'm a buyer, let's start with like just the normal pre-qualification process. What credit score do I need to have to even start this conversation?
Yeah, just for a conventional loan, 640. So not even, you don't have to have perfect credit. Obviously lower credit scores are going to be hit on their pricing, on your interest rate and your monthly mortgage insurance. But, you know, sometimes there's additional ways that we can kind of combat that. But so if you're thinking about buying a home or don't even know where to start, your first call can always be to me. We want to sit down. We want to have a conversation about what are your goals. And so I'm, at least from my perspective, I'm not an order taker. I want to talk through your scenario and see what makes the most sense for you, instead of me saying, hey, you need to do this because I'm an expert and you should do this. We want to make a plan together to move that needle forward financially for you. So in a couple of years, you're sitting in an even better position than you are today. So we typically start by doing some planning around that, financial planning on what is that going to look like for you. And then we follow that with a pre-approval application. Basically, that's going to give us a snapshot and an overall look at what your income looks like, your credit, your debts, how all those play together. What can you qualify for? We do everything on the front end to make sure that you are completely qualified. We verified everything so you can feel super confident walking away with that pre-approval letter and being able to go in and get approved. Now, if you're looking at a property like this, we can use some of that rental income to offset your mortgage payment. So with a new lease, if you don't have any history of renting, or this property doesn't have a history of rental income necessarily, that the seller, maybe the seller is not willing to share that information or whatnot, we will use 75% of the gross rent. So if our gross rent is $1,800, I do math, just not in my head. We can use $1,350 towards additional income for you. So that's a lot. I mean, that, you know, can make a big difference as far as what you could qualify for. So let's just say on a property like this, you'd be looking at roughly, let's just say, I pulled some rates here real quick. Probably somewhere in the ballpark about 7.375, 7.5, with no points. If we wanted to do a point, I'm just going to assume that it's a first-time home buyer who's trying to keep as much cash in their pocket as possible. So let's say we're not going to charge any points, 7.5, let's go with, just to be a little bit conservative too. So that's going to give you a principal and interest payment of $1,578. Back up, I calculated $1,800. There's 2 units, we're only renting 1. So 900 times 0.75.
Well, that'd have been a good point if it was a 3-plex or a 4-plex.
Yeah, I was still in 4-plex mode. Okay, so 600 and so up 75% of the 900, $675 we can use as additional income to calculate for rental income. So if your estimated monthly payment, what are taxes on this property? $1,164. Oops.
Yes.
So $97 for taxes. And so you're looking at roughly a total payment with 5% down of $1,800 a month. And if we can offset that with $675 a month, you're really only looking at having a house payment of about $1,125. I'm not sure you can find a place to rent for $1,125 a month.
With the current market the way it is, I would agree with that, to get a 2-bed, 1-bath and a garage, especially to avoid a storage unit fee, right? Like you may be able to find something, but then all of a sudden you have a storage unit on top of it of $100 or $150 a month.
Sure.
So yeah, I totally agree with that. And to be clear for everybody watching, you were talking about points. You're talking about buying down that interest rate, correct?
Yeah, buying down points is really popular right now, just simply because interest rates are higher than they have been. And so basically to buy down a point, it's buying, the cost to buy down is going to depend on how much do you want to pay and how low do you want to go. The government says there's only certain amount you can buy down as a buyer. The seller can actually contribute more towards buying down your rate. But that amount is different. But let's just say you wanted to take 1% of your loan amount. So that would be 1 point. but that doesn't equate to 1 percentage rate point. So let's say today's pricing, if you wanted to go from 7.5 to 7.25, that's actually down to 7.5 to 7 is going to cost you 1% of your loan amount. So in this scenario, it's going to cost you $2,185.
I don't have a recapture calculator sitting in front of me, but we do have those recapture calculators on our websites. Typically what I've been seeing this whole year is in a scenario, just like you said, the recapture rate on that 6 months or less. So that's been super advantageous in my opinion for a lot of buyers.
7.5, and if I can actually get 6.99 today. Yeah, should I pay payment points for a lower interest rate with points? 1 point. Your break even is actually 2 years and 8 months. And your true monthly savings is about 66.46. So it really depends. I mean, a 0.5 point is pretty substantial. The average mortgage only lasts 3 to 5 years. So my goal is always that, if we're going to buy down your rate in any fashion, if it's your money, our break even needs to be at or less than 3 years. This puts you just under 3 years, which is really ideal in kind of our current state of the market, I guess you could say.
Well, and you also brought up another good point. The length of a mortgage doesn't necessarily correlate with how long you own the property. It's just the length of the mortgage, meaning at some point down the road, it's likely we're going to see a refinance boom again, and you'll likely hold the property, but get into a new mortgage with better terms.
Yes, exactly. People refinance for lots of different reasons. They refinance, because interest rates drop. They refinance because they've, increased appreciation, increased the value of their property, and they want to refinance to get out of mortgage insurance if their lender won't drop it off automatically. Maybe they're refinancing to pull equity out to buy another property. Maybe they're refinancing to pull money out to do home improvements. Like, there's a whole gamut of reasons why people refi, but with the average mortgage only lasting 3 to 5 years, you don't want to put too much in that it's going to take you 7 or 8 years to recoup that, because you're going to leave money on the table. Rates will drop before then, if and when they do. We don't know when that is, but it's highly likely it'll be prior to 7 years.
Yeah, I agree with that. Just to be clear, to be an owner occupied scenario with this loan type, you do not need previous rental management history like we see with a lot of these other loans, correct?
Correct. Mm-hmm.
Well, that's a big deal in itself, because previous experience working with investors that they have 20% down, or they got enough money slush fund to go buy 2 or 3 properties, and pretty soon the limiting factor is, well, the bank wants to know if you got prior rental history management under your belt or in your portfolio, and that becomes a huge obstruction for more buyers than we want to admit, I think. So again, this is another one of those where the barrier of entry gets dropped and gets you in the door quicker and easier for a good lot of our customers.
Mm-hmm.
Something else I think is worth reiterating. So you're on, doesn't matter if it's a duplex, 3plex, 4plex, the loan to value is 95%, whereas before a duplex was 85% and a 3 and a 4plex was 75%. So they've really kind of simplified that.
Mm-hmm. Absolutely.
That's awesome. You got anything else to add to this?
No, I mean, it's fairly simple, but you can still qualify on these with being a first-time home buyer. There's a couple of benefits on a conventional loan. Really, the biggest benefit is if you fall below 80% of the adjusted median income for the county or the area that you're purchasing in. So if your income falls below that, you can still qualify for a home ready or a home possible loan, which basically what that is it keeps you with lower mortgage insurance, and it puts caps on your loan level price adjusters, which are basically risk assessments to your interest rate. So the short of it is you can typically get a lower interest rate by being a first-time home buyer if you fall under that 80% of adjusted median income. So, which in like for Sheridan County, it's like 86,000. I think Campbell County is about the same. Let me look.
Just for fun, back to the you're talking about all that for a second, but what kind of income would I have to afford the $1,125 a month income or payment right now, do you think?
Yeah, if you don't have any additional debts, whoops.
Meaning credit card, vehicles, the full gamut.
Right. And if you have good credit, you can make as little as $2,500 a month.
Whoa. Well, that opens up to a whole sea of people that are sitting in rentals right now thinking they can't afford anything. Wow.
Yeah. I mean, that's pushing the ratios as high as they'll typically be approved up to 45 on the front end. So there has to be some compensating factors, but somebody who makes and keep in mind it's gross. So somebody who makes $3,000 a month could easily, I mean, as long as they're not carrying a ton of debt, could easily qualify even, 2,500 to 3,000 times, whoops. Yeah, better. But
well, that really kind of puts this in perspective. If somebody has an income of 36 to 40,000 a year, or they're, a single mom or a single dad, or, a single income producing family, wow, this really opens up some doors. That's awesome.
Yeah. The area median income in Campbell County is $84,880. So, which honestly, a lot of households really, qualify. And the nice thing about the Home Ready and Home Possible is that it is not eligibility based. So like some, first time home buyer programs, for instance, WCDA, if you have somebody living with you, even though they're not on the loan, you still have to count their income towards that income goal. That is not the case. In fact, you can not include income as long as you still qualify. It's only on the qualifying income, which is a huge benefit. Saves people a lot of money.
Well, and right back to one of your initial comments when we started this is everybody's situation is different. So you can't assume it's an easy yes or no based on your situation. You really need to sit down with you and visit and put together a plan, a good financial plan that works for you.
Yeah. Yeah. Your house can be a huge net worth builder and, huge financial asset if you work with a mortgage lender who is really a mortgage advisor that's really going to set you on the path to success. Because the average homeowner is just going to sit and pay on their mortgage forever and ever, and they're not technically building a lot more wealth. So we want to put you on a plan that's going to help you to become wealthy.
Well, and I'll add to that because I know this based on feedback from customers that you and I have worked for previously throughout the years is it's got to be a mortgage lender that's willing to stay in touch after the sale, not just before, but after. You can't just be an order taker and a paycheck collector. Right. It's got to be a plan that's before, during, and after that really sets people up in our communities for success.
Yep.
You got any tips? You got any other tips in the current buying market that we're in as far as your end of the spectrum goes?
If you're on the fence about buying, get off the fence and do it, as long as it's something that you can afford to do, because here's the deal. Interest rates are higher. Interest rates are going to come down at some point. But when you look at the cost of waiting, the longer you wait, the more expensive it's going to get. Even today's priced house at 7 or 7.5%, when those interest rates drop and those values go up substantially, your payment ends up being much higher. So do you want to pay a lower amount and then just be able to refinance later? That is going to move you forward financially much quicker than waiting. Also, I read a statistic the other day that when rates drop 1%, 5 million more buyers enter the buyer pool. So what that means is we're going to see over asking prices again. We're going to see people waiving contingencies, waiving appraisals, waiving inspections, all of that kind of stuff. And so as long as you can afford the payment, get in now, be able to recognize that appreciation. We're naturally seeing appreciation, but especially when rates drop, we're going to see crazy appreciation again. And so instead of you paying $50,000 or $100,000 more for the same house at a lower rate, it's still going to cost you more than if you bought it at a little bit higher rate today.
Yeah, I concur with what we're seeing on our side too, is if and when rates drop, expect prices to go up because the competition is going to get a whole lot more fierce again, which is an interesting thing to be a part of in our the world of real estate. I think it's been, if this has ever happened in the past, it's been a long time. We did have a question on here. And I know it's Steph, you typed the answer, but I'm going to go ahead and it's just hammered out here so everybody else because there was people that wanted to see this today and weren't able to. So I just want to get this out there. The question was, my daughter is a nurse. Can she get a loan? And 2, do you qualify for a special loan? So that's a two question comment.
Not necessarily a special loan. I mean, I guess it's, sometimes there are incentives for first responders, people in the medical field, teachers, things like that. But it really kind of depends on her situation and what, I mean, there's doctor loans, but her situation is going to be different than the next nurse who I get an application from. So there's definitely options. So absolutely worth having a conversation about. And my goal is always, if they don't qualify now, let's put you on a path so that, in 6 months, 12 months, maybe even sooner, you are in a position to buy so that we can get you there as quickly as possible.
Well, and 2, I would say, I don't know all this stuff as well as you do on the lending side, but sometimes you may qualify for a special loan, but then there's a special rule or some sort of hoop that will be restricting either now or later. And in this example, to buying an income producing property and making it your home and then eventually turning it into full-time passive income. That's one of those traps that you can kind of get into if you're led into the wrong rabbit hole, I feel like. So just experience from my end once in a while.
Yeah, absolutely.
Is there any more questions from our live audience out there? Well, seeing if you do, maybe you think of something later, or maybe we, you missed the recording today or whatever. Drop us a note in the comments section or call or text either one of us. Stefanie, how do people get a hold of you?
Yeah, my cell phone's the best, 307-689-9234. Or you can find us on the website at altitudehomemortgage.com.
Awesome. And yeah, just remember that anybody out there can reach out to Stefanie or myself or both of us, vice versa, and start building your real estate team. And if this is something that interests you, whether you're the first time home buyer or this is going to be your last play of your life, either way, we're here to go to work for you. So, or somewhere in the middle, like you might be somewhere in the middle, you just never know. So be sure to reach out to myself or Stefanie at any time, and let's start putting together a plan for you. Still don't see any questions coming in, so I think we're probably all good. So yeah, I think that'll probably conclude our video today. Be sure to subscribe, leave a comment, toot the horn, whatever. And either one of us will get back to you. Talk to you later.
Thanks.
Scenario is that so she's at the 521 property, and if I found a duplex that would work for her, I can have her do that, and then I can rent out the other one.
Yep, absolutely.
Okay, so I might consider that because trying to become a passive, get some passive income coming in.
Yeah.
And I appreciate the training that I learned today, because I'm planning to become a real estate here in Virginia or Wyoming. But currently still working for the government right now, and might be working for another year.
Okay.
So like you were saying before, if you're gonna buy a property, do it now instead of wait to become to jump into this.
Charles, I think that was an excellent question about participating with your daughter, and Stefanie saying that you know, if you were a co-signer and she was also on the loan, that's a pretty doable scenario. I hadn't even thought about that. So thanks for asking that question.
Okay, yeah, because I'm thinking that if we can get a property in, well, I don't know I can coordinate with Kenya for property duplexes in Gillette, closer to my daughter's job.
Yeah, absolutely.
Okay, perfect. And I appreciate this opportunity. I will be joining any other training opportunity I might have available. I learned a lot today, and I appreciate your time and consideration.
Thanks for joining us.
All
Yeah,
right,
thank
then.
you, and thank everybody else for joining us too.